Hello, my name is Jason Mercer, the Toronto Real Estate Board's Director of Market Analysis. With the first quarter of 2015 complete, let's take the next few minutes to look at some of the key trends that have emerged over the last 3 months, and also look forward through the end of the year with a revised forecast for sales and average price for the TREB market area. Now, total sales reported by Greater Toronto Realtors amount to 19,594 transactions in the first quarter. This result represented a 9.8% increase compared to the first 3 months of 2014, when 17,851 transactions were reported. Now, sales were up for all major home types as home buyers continued to take advantage of the favorable affordability situation, which has obviously been underpinned by record low borrowing costs. We are now seeing 5-year fixed-rate mortgages advertised for below 3%, representing a substantial discount off of posted rates. Now, when TREB measures affordability, it's considering the share of the average household income in the GTA that would go towards mortgage principal and interest, property taxes, and utilities, assuming the purchase of an average-priced home with a 20% down payment. Now let's take a closer look at affordability as it relates to price in the first quarter. So the average selling price for the GTA as a whole in Q1 was $594,827, which was up by 8.3% compared to the first quarter of 2014. At this price point, with a 20% down payment and the average posted 5-year fixed rate, approximately 36% of the average household income would go towards major housing payments. So there is no doubt that this share has increased over the last couple of years, but is still below the 39% ceiling mandated by the federal government in 2012. So one final point I would like to highlight before turning to the outlook for the remainder of 2015 is the fact that all housing market segments have not performed equally in the GTA. We could see this clearly when we look at the months of inventory indicator for low-rise home types, including detached, semi-detached houses, and townhomes, which was at or near record lows during the first 3 months of the year. Now remember, the months of inventory, or MOI, is calculated by dividing active listings by sales, representing the relationship between demand and supply. When MOI is low, it means that we are experiencing a tight market with a lot of competition between buyers. Now, tight market conditions are exactly what we continue to see for low-rise home types. It was these home types that drove price growth in the first quarter, and indeed the last 2 or 3 years. By contrast, the MOI for condominium apartments, while trending lower in the first quarter, remained quite high historically, as record new condominium apartment completions over the last couple of years has led to an increase in the number of apartments available for sale. So this is why price growth for condos, whether we're talking about average price or the MLS Home Price Index, has been more moderate, slightly above the rate of inflation. Now, because of the difference in market conditions between low and high-rise segments, the gap between the MLS HPI benchmarks for detached homes and apartments continued to widen in the first quarter. So with all this in mind, what do we expect for the last 3 quarters of 2015? Well, let's start with sales. We talked earlier about affordability and its impact on sales. Now, because borrowing costs factor so large into the affordability equation, let's first have a look at our outlook for interest rates. Now, the Bank of Canada recently estimated that there was no growth in the Canadian economy in the first quarter of 2015. On top of this, GDP is expected to grow slightly below 2% for 2015 as a whole, and inflation is expected to be quite subdued. And so as a result, the bank left its target for the overnight lending rate at 0.75%. And so with this in mind, the calculated market consensus also suggests that there will be little movement in longer-term interest rates, like the 5-year Government of Canada bond, for example. Now, at the time of filming this outlook, the market expectation was for a minimal increase of approximately 10 basis points by the end of the year in the yield on the 5-year Government of Canada bond. And this yield is important because it provides insight into what it costs lenders to raise money to turn around and lend out to home buyers through 5-year fixed-rate mortgages, which remain the most popular mortgage product. Now, assuming the spread between the average 5-year fixed rate mortgage and the 5-year bond remains similar moving forward, there will likely be little change to borrowing costs for the remainder of this year. So obviously, mortgage rates will be a positive factor when it comes to the demand for home ownership. However, at the same time, people need a job and income to carry the mortgage in the first place. So now, with below normal economic growth expected for this year, there will obviously be concerns surrounding jobs. But the impact of the drop in oil prices and related issues will not be uniform across the country. Western provinces concerned with oil extraction will be the hardest hit. In contrast, in Ontario, the impact of lower oil prices is expected to be at least offset by the decline in the value of the Canadian dollar and benefits that has on the export sector and other sectors like tourism as well. So Ontario, with the GTA included, is poised to outperform from an economic perspective, and that bodes well for job creation. In fact, the unemployment rate for the GTA trended lower through the end of the first quarter. So with affordability remaining a positive, and with Ontario and the GTA expected to outperform from an economic growth perspective, sales reported by GTA realtors are forecast to grow again in 2015. In fact, we are revising upward the forecast presented at the beginning of the year to 97,000 sales, which would be a new record for sales reported by GTA realtors. Now, it's important to point out that given the degree of pent-up demand in the marketplace due to a persistent lack of low-rise listings, we could see sales reach 100,000 if we saw a sustained increase in the supply of homes for sale. Thus far this year, however, it would appear that many homeowners have decided to stay put, perhaps deciding to renovate rather than move. And so the discussion of listings is a nice segue into price. Because with demand remaining strong and listings remaining constrained, there is really only one way for selling prices to go, and that's up. Price growth will be driven by the low-rise market segments, although the condominium apartment segment is also expected to experience price growth, albeit at a more moderate pace, slightly above the rate of inflation. So the overall average selling price for the GTA is forecast to come in at $614,000 for calendar year 2015. And this also represents an upward revision compared to the forecast released at the beginning of this year. The reason for the upward revision is twofold. First, as already discussed, listings have remained scarce, so the competition between buyers will remain strong through the remainder of the year. Second, in some market segments, we have seen a shift to more expensive housing options, perhaps as a result of people taking advantage of lower interest rates. Quite simply, their dollar goes farther. So when we compare the average price growth with what we have seen for the MLS Home Price Index, which estimates prices for homes with the same attributes from one period to the next, we see that growth in the average price has been more robust. And so again, this suggests a change in the mix of homes sold this year compared to last in favor of higher end properties. However, regardless of how you measure price, it is clear that price growth has been quite strong for singles, semis, and townhomes, and above the rate of inflation for condominium apartments. So with this, that concludes this outlook. I look forward to speaking with you again in the early summer. Thank you very much.
Brought to you by GTA Realtors.